The European stock market is currently closed. As of the final trading session on Wednesday, December 17, 2025 at 1740 CET, ASML Holding NV, trading on the Euronext Amsterdam under the ticker symbol ASML, closed at a price of €874.00. This represents a significant intraday decline of €34.60, or approximately 3.81%. While most of the market was fixated on the usual suspects like Nvidia stock or the latest volatility in Tesla stock, ASML quietly endured one of its most telling sessions of the year. Most investors see a nearly 4% drop in a monopoly like this and assume it is just a broad sector rotation or a macro hiccup. However, the insight that many are missing involves the aggressive repricing of the 2026 China revenue cliff. We are seeing a specific group of institutional sellers moving out of the way before the January guidance update, even though the company is guiding for a massive fourth quarter. This creates a fascinating curiosity loop. Why would a company predicting nearly €10 billion in sales for the next 3 months see its stock price get hammered today? It's because the market has stopped caring about the record-breaking 2025 and has started obsessing over the vacuum that China will leave behind in 2026. When you look at your Robinhood app or check your individual brokerage account, the common narrative you hear is that ASML is the most important company you have never heard of. People tell you that because they own the patents on extreme ultraviolet lithography. They are untouchable. The expectation is that as long as AI grows, ASML grows. But the reality we are seeing in the price action today is far more complex. The market is beginning to realize that while AI demand is real, it is currently concentrated in a very small number of high-end chips. Meanwhile, the bread and butter of the semiconductor world, the mature nodes used in cars, appliances, and industrial tech, is facing a massive glut, particularly as Chinese domestic capacity comes online. This is where the tension lies. Investors want to believe the AI story is a universal lift, but the data from today's trading volume suggests that the reality of geopolitical decoupling is finally starting to outweigh the optimism of the AI hype. When you look at the daily swings we saw during this session, the selling pressure intensified toward the final hour of trading in Amsterdam. We saw a volume of over 760,000 shares, which is notably higher than the recent daily averages. This suggests that this was not just retail investors using online investing tools to trim positions. This was institutional liquidation. When you see this kind of movement, you have to look at the broader sector. While Apple stock and other consumer tech names have shown some resilience, the equipment makers are getting squeezed. There's a growing concern that the massive capital expenditure we saw from Intel and Samsung throughout 2024 and 2025 is reaching a temporary saturation point. If you are using interactive brokers to track the order flow, you would have noticed that the bid-ask spread widened significantly during the midday dip, indicating that the liquidity for large blocks was drying up as buyers stepped back to see how far this knife would fall. For those of you managing your own investment, perhaps through a self-investing strategy or using the Fidelity mobile app, it is important to understand the specific macroeconomic pressures here. We are dealing with a double-edged sword. On one side, the European Central Bank's interest rate path has remained more stubborn than the Federal Reserve's, keeping the cost of financing for these multi-billion euro chip factories high. On the other side, the export restrictions are no longer just a possible risk, they are a line item on the balance sheet. In their recent communications, management explicitly stated they expect China revenue to decline significantly in 2026. Today's 3.8% drop is the market's way of saying it doesn't believe the global strength mentioned by the CEO can fully compensate for that loss in the near term. Comment below how many shares of ASML you currently hold and if you are planning to add more during this dip. To understand why this move matters, we need to look at what ASML actually does. They are the only ones on the planet capable of making the machines that print the smallest circuits. Their EUV systems are basically the gatekeepers of the entire tech world. If you want to build a chip that competes with NVIDIA stock, you have to use an ASML machine. Their business model is built on selling these massive 200 million euro systems and then charging for ongoing maintenance and software updates. It's a fantastic business on paper. Their Q3 2025 report showed 7.5 billion euros in sales and over 2 billion in net income. They are even guiding for a stronger Q4 with sales potentially hitting 9.8 billion euros. But here's the catch. A huge portion of their recent growth came from Chinese firms rushing to buy older DUV equipment before more sanctions kicked in. That pull-forward demand is a sugar high that is about to end. Historically, ASML has always been a boom-and-bust stock, despite its high-tech moat. If you look at past performance from previous cycles, the stock often peaks months before the actual revenue drop occurs. This is the classic buy the rumor, sell the news dynamic, but in reverse. The market is selling the anticipation of a 2026 slowdown. While someone using Schwab Intelligent Portfolios or other robo-advisor tools might see the long-term upward trend, active traders on the Fidelity trading platform are looking at the immediate technical breakdown. The stock fell through its 50-day moving average today, which often triggers automated selling programs in many professional trading setups. If you are looking for investment help or exploring different investing sites to find where the bottom might be, you have to consider the high-NA EUV rollout. This is the next generation of their technology, costing upwards of 350 million euros per unit. Intel has already taken delivery of the first ones, and TSMC is following suit. The expectation was that these machines would drive a new wave of growth starting in late 2025. The reality, however, is that these machines are so complex that the time to yield, the time it takes for a customer to actually make money using them, is taking longer than expected. We're hearing reports that volume production on these 2 nanometer and 1.4 nanometer nodes won't really hit its stride until 2027. This leaves a dead zone in 2026 where the old China revenue is gone and the new high-NA revenue hasn't quite scaled up yet. When you compare this to the stability of something like Apple stock, you see the difference between a consumer staple and a capital-intensive industrial giant. ASML's fate is tied to the capital expenditure budgets of 3 companies, TSMC, Samsung, and Intel. If any one of them decides to push their factory expansion back by 6 months, ASML loses billions in projected bookings. Right now, the sentiment around Intel's turnaround is mixed, and Samsung is struggling to catch up in the HBM space. This puts an incredible amount of pressure on TSMC to carry the entire load for ASML's growth story. If you were using SoFi Invest or a similar platform to track these correlations, you'll see that ASML's stock price has become increasingly tethered to the health of the Taiwan semiconductor ecosystem. So, where do we go from here? The future outlook for ASML depends on whether the AI at the edge narrative actually takes off. If we start seeing AI chips in every phone and laptop, the demand for the intermediate chips made on ASML's older DUV machines could stabilize the 2026 outlook. But if AI remains a data center-only phenomenon, then the capacity built over the last 2 years might be enough for a while. The risk is that we're entering a digestion period for the industry. The opportunity, of course, is that ASML is a unique asset. You can't just build a competitor to them. It would take decades and hundreds of billions of dollars. This gives them a level of protection that most companies in the Interactive Brokers database simply don't have. For those of you utilizing Fidelity Wealth Management or other high-end services, the advice often focuses on the 2030 targets. ASML believes they can reach 44 billion to 60 billion euros in annual revenue by the end of the decade. That's a massive jump from where they are now. If you believe in that 2030 number, then today's 3.8% drop is just noise. It's a blip on a chart. But for the person who is self-investing and needs to manage their risk on a month-to-month basis, these swings are painful. Using a Fidelity brokerage or a Robinhood app allows you to see the real-time destruction of value, and it requires a strong stomach to hold through these geopolitical transitions. The central insight from today's movement is that the China decoupling is no longer a theoretical threat, it is being actively priced into the stock. The expectation was that the AI boom would be a perfect shield, but the reality is that ASML is still a cyclical company subject to global trade winds. Today's close at €874.00 shows that even the most dominant companies have to face the music when their lead markets start to shift. We saw institutional selling, a breakdown of key technical levels, and a clear signal that the market is looking past the strong Q4 guidance toward a murky 2026. As we wrap up this analysis, remember that the contrast between what the market expects